Okay, hi everyone. My name is Ken. I'm the Safe Investor, and my goal is to help you make money and stay safe at the same time. Today, I'm going to share a very powerful strategy used by Warren Buffett, and anyone can do it if you're new in the stock market or if you're new to the crypto trading world. This strategy can help you hedge against the market drop. Okay, so just a disclaimer before we start the video. All the stuff that I teach here is only for education and demonstration purposes only. Please do your own diligence before you follow my strategy. Okay, so let's begin. Don't wait, I can share my screen. All right, when when we talk about Warren Buffett, the thing that he recommends to beginners is to buy the index fund. Now, this will completely blow your mind. So if you have no idea, if you're new and you have no idea what the stock market is doing, let me show you something. The S&P 500, that's the index fund. It has been going up since 2008. So as you can see right here, even in the drop in 2000 and during the COVID drop in 2020, you can see that it actually grew a lot. So it actually grew so much. So what's the percentage? If you're a completely new beginner, you don't want to pick individual stocks by yourself. If you had just invested in this ETF or the index fund and you bought it during the drop, in the COVID drop in 2020, you would have made 77% in 2 years. So this means that it's approximately around 35 or more than 35% for the last 2 years. Okay, so now, so this is how we are going to hedge against the market. So how do you actually do this, right? If you are a stock investor or if you are a beginner, you're afraid to lose money. Don't worry, okay? Don't worry. First, what we want to do is first step, we want to buy the S&P 500 when you see a drop, right? And then the second, you kind of want to, if you have attended my Catch the Bottom technical analysis course before, you will kind of want to try to predict where the bottom could be. Okay, but it's fine if you're new. You don't have to catch the bottom. You can just buy a few shares when it's dropping. Okay, so it's as simple as that, and then you make money. Okay, so now, so let's pretend let's pretend that you actually bought something around here. So now what you can do is you can hold on to this index fund, right? You can hold on to this index fund, and let's say if it goes all the way up to here, right? Then you feel like there's something that's bad that's going to happen, right? Don't worry, don't sell it. I will teach you a powerful method to help you hedge against your risk and also boost your return. So if we go back and look at the index fund, there are two index funds in the United States. There is the S&P 500 and there is the Nasdaq 100, which is QQQ. Okay, so if we look at these index funds, you can see that they are sorted by the market cap. Their weighting is different. You have Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, NVIDIA, and JP Morgan. Okay, so now these are the top 10 companies inside this index fund. Same with the Nasdaq 100, which is QQQ. They have about almost the same companies inside. Okay, so now when the market drops, so let's say recently there was a market drop right here. So oops, let me delete that. So when the market drops, the individual stock will always drop a lot faster than the index fund. Same when the market goes back up, the index fund will always go back slower than the individual shares. So that's how we're going to use this to really help us. Okay, so this is the S&P 500. If you actually pull this chart all the way here, you can see that right now it's about a 2% drop right now. Okay, it's about a 2% drop right now. Okay, so it's not too bad. Now, if you look at individual shares, so for example, if you look at Apple, the 4.9% drop. Okay, if you look at Microsoft, it's a 5.92% drop right here. So what does this mean? It means that when the market drops, you can see right here, you want to drop less when the market drops. At the same time, you want to boost your returns when this goes back up. So this basically means that when the market is up high, so for example, when the market is up high around here, if you know how to look at stochastic, you can look at stochastic. You will want to sell your individual shares. So it can be Microsoft, it can be Google, it can be any shares that at the top. At that time, you can buy into the index fund, right? So you can buy into this index fund right here. Now you let it drop. You don't do anything crazy. You let it drop. So right now, your portfolio will be down 2.56% right here, which is fine. Now don't worry, because at this time, what you can do is, that's called hedging, right? Now, how do you boost your returns? You can boost your returns by buying back into the individual stock. So for example, if we go back and look at Microsoft right now, Microsoft, it has a 5.54% drop right here. So it means that when it goes back up to break into the new high, you will have you'll have more space for that gain. Same with Adobe right here. Adobe had a pretty decent drop right now. If you look at the chart right here, Adobe had a 23% drop right now. So if you held onto the index fund, right, you only drop 2%, you don't drop 23%. You sell that 2%, sell that index fund, and buy into this Adobe stock. Okay, now when do you need to hedge again? Very simple. When this Adobe stocks goes back to this previous high right here, or when Microsoft goes back to the previous high, you want to hedge against it. You simply sell the Microsoft and you simply buy into the QQQ or the S&P 500. Okay, so now there's a second strategy. You can also use the QQQ and SPY to hedge as well. So let me show you how to do it. So let's say, so we know that the S&P 500, you can look at the drop right here. It's only dropping 2 points because right now we're in the bear market. You can see that the S&P 500 is dropping around 2.73%. The NASDAQ 100 QQQ, it will drop more. So it's going to drop 5.71%, right? So if you don't want to pick individual stocks, if you're new, right, what you can do is you can alternate between these two ETFs. Now, this is very, very powerful because when you drop less, you drop like 0.2 something percent, drop 0.2 something percent. When you grow, right? So what I'm saying is when the market is high, sell your QQQ shares, buy into the S&P 500, you drop less, right? You drop less, like drop 2%. When the market is dropping low right here, you want to sell your SPY, you sell your S&P 500 and buy into the NASDAQ 100 simply because when it goes back up, it will go back up faster. And that's actually a very, very simple and easy strategy. You don't need to worry about individual stocks crashing down for any reason, right? So you follow the index fund. So that's something that Warren Buffett recommends. He said that for old investors and new investors, he highly recommends you to buy the index fund because if you don't know what index fund is, the index fund is weighed by the market cap. So the larger the company becomes, the higher the share price goes, the larger the company becomes, the higher the weighting it will be in this index fund right here. Now, the good thing about that is when the company becomes larger and larger, it will have the power to pull other companies inside this index fund. So that's that. So now another good thing about an index fund is that it automatically helps you manage the weighting. So for example, so let's say Apple right now has some big issues, and if you had bought into this index fund, if Apple dropped a lot, what would happen is that its ranking will go all the way down. And when the ranking goes down, the weighting goes down, it has a less significant impact on the index fund. So that's a good thing because you don't need to sell your Apple shares and buy other things. But by buying an index fund, it does that automatically for you. So what could happen is Apple could come down and then it will have a lower impact on the index fund, and some other companies around here, it will go back up, and when it goes back up, it will have a higher impact on the index fund as well. So that's what Warren Buffett recommends. Now, it is very important to follow this strategy, and because I'm called the safe investor, if you follow this simple strategy, you can actually avoid a lot of trouble. I'm not even joking about this. So if you look at the S&P 500 right here, if you look at it right here, and you look at these two drops right here, there was a that was the 2000 dot-com bubble. This one was the housing crisis, right? So now, this is the Nasdaq 100 QQQ. So that was the that was the dot-com bubble, and then this one there was the housing bubble right here. Okay, so it's very important for you to alternate between these two ETFs. Okay, you have the QQQ and SPY 500. So if you didn't alternate between these two ETFs, right? If you don't think about safety, what could happen is the same thing could happen. You look at 2000, the year 2000 right here. It took 16 years, 16 something years, or maybe 17 years for this index fund to recover to its previous peak. Okay, so for the what about the S&P 500? So for the S&P 500, it only took, after the dot-com bubble right here, it only took 8 years for it to reach the previous peak, and then it crashed again. But then it took another, let's say, 8 to 5, maybe 5 years, and it recovered really fast. Okay, so if you use this simple strategy to alternate between QQQ and SPY, what could happen is during this drop, right? You drop with the S&P 500, you drop right here. So I'm gonna add in compare. I'm gonna add in QQQ. So there we go. So right here, right? You can see when it drops, the S&P drops less than the QQQ right here, right? Now when when it hits the bottom, if you attended my courses before, you know how to catch the bottom. What you could have done was you sell your SPY and buy into the QQQ. So what could happen is if you bought it at the bottom right here, you will have made 1,000% throughout this entire time, right? Same with, let's look at COVID. If you did this strategy during COVID, what could happen is right here. Let's see, is this big enough? Let's see, 6 months maybe. All right. Okay, so COVID was a panic, so that's a little bit different. So maybe let's look at some the recent one right here. So recent one right here. So that's at the peak right here. So you can see that the QQQ dropped 5%, SPY only dropped 2%. So what you could do right now is if you have SPY or the S&P 500, sell the SPY 500 and buy the QQQ. When the QQQ goes back to the previous peak, sell the QQQ and buy back into the S&P 500. And that's it. A very simple strategy. It can help you boost your returns and help you hedge against your risk. Okay, so now some of you have asked me how to do it on cryptocurrency. Okay, so let me explain. So now when we want to, I'm following Warren Buffett's advice. You want to, so since the index fund is based on weighting, we can also do this with using cryptocurrency. So right now, the top two heaviest cryptocurrencies in the world are Bitcoin and Ethereum. So if you look at the chart right here, Bitcoin, USD, see Coinbase. Okay, so if we compare Ethereum with Bitcoin, let me do that. BTC, USD. Oh. All right. So let me see. Okay. So right now there's actually a pretty big drop happening right now. Okay. So now these two instruments are actually they're actually fine. Let me get rid of the lines. They're actually, because they are the largest ones, and people do believe in them. So I want you to know something. When there's a panic happening, most of the time, Bitcoin will drop more. Okay, most of the time, and this is simply because Ethereum just has more more use compared to Bitcoin. So Ethereum, most of the time, it will recover faster. And if you look at the chart right here, let's look at the 1 year chart. You can see that Ethereum has grown 151%. Bitcoin has only grown 14%, right? If you look at the 5-year chart, you can see that Ethereum totally destroys Bitcoin. 6-month chart right here, Ethereum still at the top. 3 months, Ethereum still at the top. 1 month, Okay, the 1 month is different, but we want to look long term. We want to look long term, right? So what you can do is, I would say, if you really think about what recovers faster, I highly recommend Ethereum. Using Ethereum and stable coins. So what stable coins are. If you know what stable coins are basically USDC and USDT coins. So what you can simply do, and this is what I've been doing. So I use this to do my entry. I'm going to take out the Bitcoin. I use this to do my entry. I follow the Fibonacci retracement levels. So I have a bunch of, when the stock market is like up high right here, I sold all my Ethereum coins, sold all of them, bought into the stable coin with the USDC. Okay, and then why did I do that? Because by doing that, I can simply gain a 12.3% on a weekly basis, and it's a fixed rate without any lock-in periods. Okay, let me say that again. 12.3%. You get paid weekly with no lock-in periods and at a fixed rate. I know. So there's crypto.com. You would have to lock in you have to lock it in for 3 months to gain that 10%. Celsius, you don't need to lock in, but you would need to the rate changes. It's not fixed. This APR is not fixed. BlockFi is also not fixed. Binance, I think it's not fixed. Okay, so for the best stable coin for you to use, I'm talking about USDC and USDT. Definitely the best one is UHodler, because it's a 12.3% weekly basis, no lock-in period, and fixed rate. Okay, you don't see that in any other bigger platforms. Okay, so that's what I did. I sold all my Ethereum and bought into this stable coin. And now I can see this drop happening right now. So I'm hedging. I'm kind of protected because I have my USDCs, right? And then I'm using that 12% weekly interest to buy small batches into according to these Fibonacci retracement levels. Okay, so now if Ethereum drops more, I'm not afraid. Okay, first of all, because if you understand the value of Ethereum, I would say 80 out of 90% chance that Ethereum is going to go back up, and a lot of things happening on the NFT chains and all that stuff that's happening in the crypto world right now. So I have high confidence for Ethereum to go back up. And then what's good about this is that during this time, I buy in like small trenches and small bulks. I still get a 5.5% fixed interest rate paid weekly without any lock-in period. So if you compare it to other major platforms, crypto.com, you get a 5.5%, but I think you need to lock it in. I think there's like a lock-in time. Celsius, the rate varies. Binance, you can't do that. BlockFi, the rate varies as well. So only this platform right here can give you a fixed interest rate, pay you weekly without any lock-in period. So that's what I've done. So I get paid weekly. So I buy, I sold some of my USDC, buy Ethereum. I get my Ethereum interest, get my Ethereum interest. And what would happen, it doesn't matter, because if it takes longer, then that's fine, because I still get my 5.5% interest right here. I just simply accumulate more Ethereum coins. And if I want to use this hedging strategy, again, it's very simple. When Ethereum goes back up to like some previous high right here, right? I made money. I actually made more money because of the interest rate right here. Then I would just buy back into my USDC coins. I would just buy back my USDC coins. Let that compound interest of the 12.3% really to help me. So that's how you hedge. Now, is this the best strategy to make a lot of money? I would probably say no. It's not a very fast strategy to do it, but 100%, it is the most guaranteed way for you to make money as a beginner. If you don't want to guess the trend, if you don't want to look at the market and freak out, and you don't want to guess the trend going up or down, this is 100% the safest way. You collect your dividends. Your interest rate weekly, and then you do this hedging strategy using the most trustworthy coin. and then the most stable coin, which is USDC, and you alternate between them. You collect your interest rate. You buy Ethereum when Ethereum crashes. You sell Ethereum when Ethereum is up high. You buy back into the USDC coin, and then you rotate the strategy, and you are guaranteed to make money. Okay, so that's that. If you don't have, I actually shared this. I shared this a lot already. If you don't have this, if you huddle account open, I will share the link below because it's super duper powerful and useful, and anyone can do it. Anyone can do it. So I will post the link below right here. Okay, so I hope you like this sharing, and that's it for me today. Thank you.